Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, you might recall last week I did a video talking about the probability of the Federal Reserve lowering interest rates. And there's a high probability that that happens, at least according to the odds makers. So today I'm going to share with you some history and what a potential lowering of rates might mean for stocks. And by the way, if you find value in this video, if you see this video on the socials, on Facebook, LinkedIn, or even YouTube, go ahead and share it. Or if you get it in an email, go ahead and forward to a friend. So let's jump in and explore. I have some potentially good news. And as I'd mentioned, there's likely rate cuts ahead. There's been a lot of information in the news recently. Here's the potentially good news. Now, when the S&P 500 is within 2% of its all-time highs, after the Fed cuts rates, what happens a year later? That's a kind of a mouthful. So what we're going to look at is how the S&P has historically performed when it's within 2% of its all-time highs, which it is right now, after the Fed cuts rates. Hopefully that made some sense. Now, according to Carson Group's analysis, the Federal Reserve has cut interest rates with the S&P 500 within 2% of its all-time highs on 20 separate occasions since 1980. Now, here's the really good news. Each time the S&P 500 was trading higher 1 year later. So I'm going to repeat that again. The S&P 500 is within 2% of its all-time highs. Now, assuming that is still the case, and assuming the Fed lowers rates at the next meeting, which is coming up in the near term, assuming those two things happen, if you look at history since 1980, where again, the S&P is within 2% of its all-time highs, and the Fed cuts rates when the S&P is within 2% of its all-time highs, 20 out of 20 times the market is higher in 12 months. In other words, 12 months later. So that's really good news. Hopefully you followed that. That was kind of a mouthful. Let me at least show you what that looks like here mathematically. Again, when the S&P is near all-time highs and the Fed cuts rates, the average return 12 months later is 13.9%. So if history is any guide, if the past equals the future, the markets will be positive 12 months later. Based on the last 20 times this has happened 100% of the time, with, again, the average return being around 14%. You could see graphically what this has looked like since 1980. You see the dots here on the chart of the S&P 500. Every time the market is near 2% of its all-time highs and the Fed lowers rates, good news happens based on probability. Now, I don't want to take away the focus here, because we all know that you must make sure you understand your risk tolerance and what your objectives are. So this does not mean go ahead and put all your money into stocks, because history says we have a 100% success rate 12 months later when those two things happen. So I wanted to stress here, you need to make sure you understand what your risk tolerance is and have a portfolio that is proactively designed to help, number one, match your risk tolerance, and number two, generate the rate of return that you need to earn now and in the future for your financial economy. And as this chart shows here, generally when you want to have a lower risk profile, you generally want to own things like bonds, treasuries, and cash. That's that 80% on the bottom left here, 80% in fixed income. And obviously, as you increase your risk metric or your risk tolerance and you have a long time horizon, you're likely going to want to take on more risk, because as you know, for example, with stocks, which are generally more volatile and riskier, you're going to have a larger opportunity to make money. The lower the risk profile, the lower the likely long-term return, the less volatility you will likely have. The higher your risk profile, the more you want to be invested in, for example, stocks or equities, which generally have more volatility and obviously a higher growth profile. So that's a lot to think about, but this is not new information. You all likely know this, but I wanted to not get distracted on what the ultimate goal is, because we talk about things like what's important, understanding what your family index number is, that rate of return that you need to earn now and in the future to live the ideal life you want that is based on your goals and objectives. But again, also within that is understanding what your risk tolerance is. All that to say is, as I mentioned, if you find value in this video, go ahead and share it on the socials, or if you get an email, go ahead and forward to a friend. And if you would like a second opinion on your portfolio, or financial situation, this is our website at nicholswealth.com. Go on the upper right-hand tab. This request an appointment tab. Fill out the information, and one of our advisors will reach out to you and answer your questions and give you some clarity in today's financial environment. Thanks again for watching. Bye-bye.